So where could SPY go next? Where could the general broad market go next, up or down? So that's what we're going to be looking at. And to help us, we're going to look at the likely data bombs that are going to hit the tape this week for the next 3 days. Seasonality is an interesting time around April. We'll take a look at seasonality charts, and there is a repeating pattern on the price chart right in front of us here. And we're going to be looking at that and what that could signal as the next level. And depending on how the data pans out, the data bombs pan out this week, we could be seeing the first signs or the early signs, not the first signs, the early signs of stagflation. And that's probably going to be a video or two that might be coming up over the next week or two. And I think that might be a theme, a trend that is likely to continue. So, data bombs this week. We've had some PMI numbers, so industrial manufacturing numbers have already come out. Job openings have come out, which were as expected, so not a huge surprise to the markets there, one way or another. We do have some ADP non-farm employment changes. So this is really useful set of numbers because it can help us to look at the possibility of what could be coming out of the non-farm. And of all the things that could move the markets here in terms of volatility, the non-farm is one of the ones that could have an outsized impact on volatility and prices, either up or down. We've also got the Fed chair speaking this week, so that's always worth paying attention to. And some of these data bombs could be the reason why we're seeing some chop in the market, waiting for the news events to pan out before people decide on whether to get bullish or bearish. So those are the data bombs this week, and we have had a little bit of sideways chop, and we might see a little bit more of that, but definitely expecting some volatility coming up. And the question is whether we're going to go down from here or up from here. Okay, seasonality. So April, we're about here at the start of April, and new month, a new quarter is a period of time when we see funds rotate in and out of positions. So there'll be a lot of repositioning taking place, but also it's a time when new money gets put to work as well. So this could be representative of why we tend to see a strong April and then a weak May. So the kind of the seasonal data points to slightly more up, and then we might see a big down. So really, we should be looking, in terms of seasonality, we should be looking for price to continue higher rather than pulling back here. That all does depend on whether people have been rotating in or out of some of the bigger positions. So have they been taking profits, locking in profits, and maybe readjusting their portfolios for other stocks that maybe are not as highly representative of what's in the S&P 500 and SPY. Okay, so seasonality, good. Data bombs this week, depends on what the news events and the volatility, so that's unpredictable. Now, the repeating pattern, if we put on our algos, we can see really from the algo here that we are in so this is the this is the higher rate, this is the upper quarter, this is the mid-range of the entire, so on a weekly basis, we are, if we just move that out of the way, this is the mid-range of the entire move. And what we're looking at is this little quadrant here. So we're going to drop back down to the hourly chart. And what we're going to do is use the algo derived ranges to create our own little mini range quadrants here. And we're just touching up against the 0.5. So this is a a risky area right now because we could flip it and then go higher, or could reject and go lower. So one of the interesting repeating patterns that's been evident on the 1 hour chart is that let's just get rid of this for now. Let's hide the algo. We're just looking at these moving averages. The 21 days. So although we're on an hourly chart, this line here is the 21 simple moving average. So if we went on a daily chart, it would look more like that. But we have made some indicators that allow us to see the daily moving averages on a lower time frame because they are very important. So what we can see here is that the 21 has been used as support, bounce up, bounce up, bounce up, bounce up, but here we tag the 30. So one of the questions here is whether or not we're likely to come back down to the 30 and then maybe see a reversal. So that's going to be the seasonal, the data bombs this week interacting with a relatively bullish seasonal action. So that's why I'm thinking that we either bounce here. So if we get positive news, positive data bombs, and positive seasonality, we could just flip higher. If we get negative news, we could dip down to the 30, see if we can find support there on the 30-day SMA, and then bounce up. So that's one factor of the repeating pattern. The other one is that what we have been seeing is might need a drawing tool here. Let's see. Let's use the brush. So we've been seeing a price hitting a ceiling, coming back to the moving averages, and then finding resistance, finding the moving averages, and then pushing up. So here again, resistance, down to moving averages, ceiling, down to moving averages, up, and then off we go. So we've seen that a couple of times, and the question is, are we likely to see it here, where we see a dip and then a push up? So that actually is what I'm currently favoring right now. Don't know if it's likely to happen, but it's definitely something worth paying attention to. Now, if price does do something like that, then we're going to be looking at these fib zones here. And what I'm looking at really is if the 21 holds, then we could see a pivot, pivot high, pivot low, and then the kind of the fibs tell us that we should, or we could reach the 526, 527 level, and depending on bullishness, we could reach up to the 520. So if we get a dip further down, then that doesn't change very much really. What that suggests is similar levels, but just a slightly higher at the top end of 530. Or 530, 531 stroke 532. So that is what I'm favoring at the minute, but that all depends on the news events and whether or not the seasonality kind of continues to hold. If we fail to do that, then we could see, we could, if we lose the 21, we've got the 30 to fall back on. But if we lose those, then we're going, we're likely to go back much lower. Not expecting that, but got to be wary of that. So in terms of risk, that's going to be an area that I'm going to be watching for, staying cautious and maybe sidelined until we see some bullishness come back into the market. If we start losing some key levels, such as the 30 SMA, then there is the potential to flip bearish completely. Not thinking that at the minute, currently looking for pullbacks to buy and then push up. Okay, stagflation. So depending on the data that comes out this week in terms of the non-farm payrolls, if we've still got strong employment numbers, we've got some hourly earnings that are still going up, and we've got a lot of economic activity, but we've also got high interest rates relative to the last few years. They're not at 6%. They're not absolutely unusual. We have had periods where we have had rates at about the 5% level for long periods of time. The issue about stagflation is that we could be seeing interest rates hold, employment levels going up, hourly rates going up, and commodity prices in particular starting to drift up as well. And that's where you start to see the early signs of stagflation, where everything is rising, including some of the inputs into the inflation numbers. So going to be watching that more closely over the next 6 months, I guess. But certainly on a kind of, not sure about week to week, but more regularly than every month, going to be looking at the impact on inflation and the impact on the 10-year yield in particular. All right, the video is long enough. So data bombs this week, seasonality, looking for pullbacks, and then looking for a push up to the 530 area, hopefully within the next sort of week to 10 days. Okay, catch you on the next one.